Hey everyone, I'd like to welcome you all to our webinar on how to evaluate passive multifamily investment opportunities in this uncertain economy. I'm joined on this webinar with my partner Jason Munson. This webinar is really for those investors who are interested in investing passively as limited partners or LPs into multifamily deals alongside general partners and sponsors. We constantly hear from investors that they see a lot of investment opportunities from a lot of sponsors, and they don't fully understand which deals to focus on, because a lot of those deals have typically the same set of returns and parameters, and they are based on forward-looking numbers, and it's not clear how to figure out which investment is better than the other. So what that means is that it's incumbent on investors to analyze the risk and reward associated with each deal and make an informed choice. We will break down the decision-making process for limited partners into essentially three key areas. One area, the first area of issue, is to do with you as the investor. The second area is about the sponsor and the general partner. And the third is about the deal, of course, that you are looking at investing in. We will also touch base on generally the market, generally the cycles of the market, and also about real estate syndications in general. But before we do that, I'd love to introduce you to our firm, Krog St Partners, and what we do. Who we are. Krog St Partners is an Atlanta-based sponsor and investor that invests in multifamily real estate with a focus on the Southeast. We target primary and secondary markets with diversified economies, stable and growing populations, and look for markets that have solid average median incomes. Krog St Partners and our principals, which is Jason and I, have successfully developed, acquired, and overseen the management over 3,000 multifamily units, which includes over 1,800 units as sponsors and general partners. And we collectively possess, between Jason and I, over 50 years of commercial real estate industry experience. Our mission statement is that we are committed to providing our investors with stable, consistent investment returns and growth of capital through prudent investments, strategy execution, management, and sale of cash flowing value-added multifamily communities in a stable Southeast U.S. markets. With that, let me just turn on our presentation, which I should have done a little bit earlier, but let me just do it now. And hope everyone can see all these slides. As I said, let me just move along the slides. As I mentioned, we will talk through this agenda. As I mentioned, we talked about Krog St Partners, our values, and now I just wanted to spend a little bit of time on our track record. We've, as Krog St Partners and us as principals, we as GPs and sponsors have invested in 18 deals with a total capitalization of $326 million, over 1,800 units, and our average realized and projected IRRs for our deals have been just shy of 20%. So with that, I would love to tell you a little bit about, lastly, before we jump into the content, I would love to tell you a little bit about myself. Me, Mohi Monam, I've spent over 22 years in the commercial real estate space. I've worked as an advisor. I've worked for property managers and operators. I've worked as a limited partner, just like a lot of you guys, but in a larger capacity with larger funds that have managed billions of dollars. So I've invested LP capital in a myriad of asset classes. And then 7 years ago, I moved over to the general partner or sponsorship side, where we would sponsor and invest in deals and would invest alongside limited partners like yourselves. And I will turn it over to Jason to give so that he can give you a little bit of background about himself.
Great, thank you. Good afternoon. Thanks for joining us today. My name is Jason Munson, also a principal in Krog St Partners. I have a long, diversified commercial real estate career spanning development. Earlier in my career, built over 1,300 multifamily units across the Southeast, as well as retail and office. I've been on the institutional side, most recently served as head of asset management for a publicly traded mortgage REIT. Have been variously licensed as a home builder, a commercial general contractor, a mortgage originator, and have a real estate sales license. So I've pretty much covered the gamut in commercial real estate. So with that, let's go ahead and move on.
Sure. So Jason, let's start off with talking about multifamily investments or investing in general.
Sure. So we're assuming that all of you joining us today have some level of understanding of the multifamily investment space, and that you understand the benefits for investing in private real estate deals. Obviously, number one is passive income. That is one of the most attractive parts of it. Tax advantages, tax benefits. Both from cost segregation and other tax benefits that the IRS allows for real estate investments. And then third, limited liability for anything that happens with a real estate deal. And again, capital growth that comes from real estate investments that you can roll into future real estate investments through 1031 exchanges that allow you to either avoid or defer taxes for a considerable period of time. So again, those are all the reasons that we like investing in real estate deals, both as general partners and limited partners. So let's go ahead and move on to the next slide. Okay. Well, first of all, to dispel any rumors, there are no secrets in real estate, unfortunately. It's a lot of hard work. It's a lot of research. And really, it comes down to coordinating a lot of third-party vendors to get a deal done. I like to say it's not a complicated industry. It's an industry that you can read books, you can watch videos and webinars, so you can learn the basics of real estate. But it's a very complex industry because there's so many moving parts. And there's so many elements that go into evaluating, what an attractive real estate investment is. So let's go into the next one.
Yeah, so let's talk now, Jason, a little bit about real estate cycles and the state of the multifamily market today as we see it.
Sure. So the real estate industry, much like our larger economy, operates in cycles, and there's been a lot in the news about that. So you may have seen a similar graphic to what is shown on the screen right now, with the 4 phases of the real estate cycle: the recovery, expansion, hypersupply, and recession. So depending on who you listen to, we're either in the hypersupply or the recession part of that. So that said, there are great opportunities in any market. Higher interest rates, low interest rates. It's really up to an experienced sponsor to find good opportunities and be able to mitigate around whatever challenges there are in that market. Okay, so there's been a lot of news headlines about bank risk, bank failures. We've had 3 of the largest bank failures in history over the last several months between Signature Bank and Silicon Valley Bank. And so really, what does that mean for commercial real estate and specifically multifamily? There, again, a lot of headlines about the systemic risk for commercial real estate relative to these bank failures. So let's go and move to the next slide to detail what those risks may be. So less lending availability. So what happens when banks are struggling? they will pull back on making new loans because they're in the process of working out their existing loans. A lot of times their regulators, whether it's the FDIC or OCC, will prevent their banks from lending more money. As a result of less activity, property values could potentially lower. If there's less lending availability, there's less people interested in purchasing properties, and therefore that could impact pricing. So those are two of the headline issues. Let's move on to the next. Increased risk. Again, a number of these banks failing had large commercial real estate exposure and portfolios. So if there's a risk of default on CRE loans, that could create more problems for borrowers looking for loans in the future, and then decreased investment. Now, the good news is that unlike the headline risk that we've heard about bank failures, the multifamily market is actually pretty strong. The lending market for multifamily is really the commercial bank lending market is actually very limited. Only about 10% of loans in the multifamily space come from commercial banks. The majority of it comes from the government-sponsored entities such as Fannie Mae and Freddie Mac and other private lenders. So the good news is there's a lot of liquidity in the market for multifamily investments, albeit priced higher. And the bottom line is the multifamily occupancies are still very strong throughout the United States.
Yeah. So the demand side, I guess we've been spending a lot of time on the capital side of multifamily, but if you actually look above the line or look at the performance of multifamily against on its own and other asset classes, but let's just talk about multifamily real quick on its own. Through the last 12 to 18 months, as rates have gone up, there was a focus on the fact that jobs are going to be cut. The unemployment number is going to tick up significantly higher. Is going to cause a lot of distress in the market. Even within multifamily, that has not happened. If anything, job growth has continued. And over the last 18 months, we've seen the sector perform extremely well from a demand standpoint. And that's because of lack of housing that is become a systemic issue within U.S. real estate.
Yeah, to the extent there have been negative headlines relative to multifamily, it has been the slowing of the rate of rent growth. It has not been the falling of rents. It's just the rate of growth has lowered in most markets across the United States, and a lot of that's driven by the fact that from early 2020 through early 2022, rental rates increased at an unprecedented amount. So what we're hearing now is not that rents are declining; it's the rate of growth is declining. So it's a very important nuance that it's important to keep in mind.
Yeah, and lastly on the issue, I think there are some markets where rents in certain segments of the market have gone down a tad bit, and that's because there's been a lot more supply that's been added in Class A. So Class A are units that are almost brand new. So when a lot of that inventory comes online, some of the other Class A properties are going to be negatively impacted by that. But the impact has not been nearly as sharp as what people had assumed it would be.
Yes.
However, in the Class B and Class C space, a lot of that rent growth has been extremely stable because blue and gray collar workers who typically are renters by necessity, not by choice, in a high interest rate environment, have no option to buy a home. And at the same time, the supply side in Class B and Class C has not increased at all because of cost of construction. And so we feel that if you look at the lack of overall supply and the strong demand, if we have withstood the pressures of interest rate growth over the last year and a half, I think we're seeing good runway going forward.
Absolutely.
Now, Jason, let's touch on, let's spend a couple of minutes on real estate syndications and what real estate syndications really mean.
So one of the reasons we wanted to touch on this is there have been some headlines also about real estate syndication and specific deals that have had some negative press. I'm by no means an insider, but from what I've been able to read and glean on those deals is those were operator issues and just poor business plans that were poorly executed. Real estate syndication in and of itself is a very old form for pooling capital. In essence, that's really what the definition of syndication is pooling capital between two or more investors for the purpose of purchasing an asset. So, that method has been employed for decades with little fanfare and frankly, little news, and honestly will continue to do so. And the syndicator, the one who manages the deal, also known as the sponsor, the general partner, is responsible for quite a bit. The syndicator identifies a property that they think is a good investment, and that we'll go into what those elements that go into a good investment. Also prepares a business plan and the marketing materials to speak to investors about. Ultimately raises capital from investors, and then at that point executes the business plan, which includes purchasing it, managing the property, and executing whatever business plan, whether it's a value add, construction, whatever happens to be. And then at some point in the business plan, the property is sold or refinanced, and investors receive their money back and whatever share of the profits there are. So again, like I said, this is not a new form of, a recent or new form of real estate opportunity. Syndications happen on an institutional level and also on an individual investor level. It offers private investors access to deals that they normally wouldn't have. And frankly, the reason we're all attracted to real estate like this is because it does give us wealth building opportunities that frankly, the stock market and bond market is not going to be able to offer us.
Great. Now, Jason, let's get into the real meat of the webinar, and let's talk about breaking down your areas that you want to focus on as a passive investor into three core areas. One is the first area is about you. Areas that you need to focus on, things you need to think about is you. Then it is the sponsor. Sorry, I misspelled the word sponsor. And then the third is about the deal. So let's first talk about you issues, which is limited partner who's looking to invest. Like, what are some of the issues that sponsors need to, not sponsors, but limited partners need to think about from their side?
Absolutely. So first of all, have you defined what your investment goals are? And if you have defined them at some point, given where we are with the challenges of the market, have you reevaluated your investment goals recently? Why are you interested in investing in real estate to begin with? Is your goal to generate regular income? Because that's one set of parameters that you have to take into consideration. Capital growth, obviously, I think we're all interested in that, but and then diversification from your other investments, whether it be stocks, bonds, or other types of investments. So go ahead and next one. So in addition to those, do you have return and timing expectations? Because real estate investments are typically 3 or more years, 3 on the short side. Some happen quicker, but we typically don't plan on those. We typically plan for 5 to 7 years, if not longer. So if you're looking, they're illiquid investments. So if you're looking to get your money back at a specific time, real estate may not be the right opportunity for you.
Yeah, but I mean, on that point, I think, Jason, you and I know this, that we have done deals where we have been in and out of them in like 3 years, right? So I think the point is that 3 years is probably 2 to 3 years is probably on the low end of the spectrum, but you really have to be solving for 5 to 7 years. Now, if you're not going to have control of those deals, so like even if you want your money back in 3 years and you think right now may not be a good time, you are at the mercy of obviously your general partnership, who has to make decisions on behalf of all the investors and when they think is the right time to exit. So, Yeah, it's a long way of saying that if you want your money back in a very finite amount of time, and that time is anything less than 5 to 7 years, I would urge you to reconsider your goals at that point.
Yeah, and if it's investment capital that you need to live on, obviously, a real estate syndication investment may not be right for you.
Well, I mean, yes, there's always cash flow that a lot of those deals will throw out. So you will have that sort of cash on cash return that those deals will be generating for you. But beyond that, if you're looking for capital appreciation, I think that's where you need to sort of figure out if this really fits your needs or not.
Sure. All right, so the quick summary on the U issues, and again, these are only questions that you have to ask yourself and only you can answer. These will determine whether you should consider real estate syndications as an investment opportunity. All right, let's move ahead. So now we get into what we call sponsor issues. Sponsor is also known as the general partner, or GP for short. And honestly, in our opinion, this is the most important element of any investment decision, particularly where we are in the market. Do you know your sponsor? Do you know what your sponsor is capable of? And do you have faith in your sponsor's abilities to identify and execute on a business plan? And really, at the end of the day, experience matters. As I mentioned in an earlier slide, real estate is not a complicated industry. You can read books and you can learn about it, but it's very complex. There's a lot of moving parts to it that we'll get into in a minute. So how long has your sponsor been in the real estate business? There are a lot of folks who transition from other industries, and that's great. But there is a time, people need to invest time and reps. It's like Malcolm Gladwell said in Outliers. I don't know if you've read the book, but 10,000 hours invested to become an expert in anything. And a big question is also, how has your sponsor handled adversity? At our points in our career, Mohi and I have been through multiple real estate cycles, ups and downs, and there are different challenges in each. So it helps to have gone through that to know what the forward runway looks like, because real estate is a problem-solving business. All right, so now we get into the different skill sets that are required to successfully acquire and run a multifamily investment. And like I said a minute ago, these aren't learned overnight. The general partner is responsible for a bunch of stuff. These are just 9 big categories that we came up with to talk about. First of all, identifying a property and completing due diligence. Let me talk about identifying a property.
Yeah, I mean, identifying a property is hard. I mean, if your idea of, or someone's idea of identifying property is like, I found this one deal and I was able to secure it because I was able to meet the seller's expectations, and then you close that deal and you think that deal was a great deal that you've done. I'm not sure if that's, I mean, it could be that, but here's how we look at things, or here's how experienced general partners and sponsors look at things. We look at hundreds of deals at all the time. So, I mean, if we look at 100 deals at one point, we will probably take 20 of those seriously. We will underwrite probably 15 of those. We will give offers to maybe 11 or 12 of those. We will probably, of those 11 or 12, be able to get to the point where we actually secure to do due diligence on 2 of those deals, of those 100 deals. And we would probably not do one of those 2 because we may find something that we just couldn't get around or sort of agree with the seller. And we would probably close 1 of those 100 deals. So that's like a success ratio of like 1%. So it is extremely hard. And that's just on like sourcing good quality deals. Now, due diligence is another part of it. I mean, due diligence is where you have to confirm that the rent roll that they've shared is absolutely correct, that you have done a full sort of inspection of all the plant and machinery and all the physical plant of the buildings, figured out, what are some of the issues, if those issues line up with their expectations. If they don't, then you got to go back to and sort of agree on some sort of credit or some sort of arrangement that would work for both parties. So there's a lot that goes into the due diligence part of things, and then obviously then closing the deal, because you have third parties involved, like lawyers, consultants, equity, and I think some of those things are covered in the next few points.
Right. So as you can see, our hit rate is you're not going to go to the Hall of Fame with 1 out of 100. You're going to go to the multifamily Hall of Fame, not the baseball Hall of Fame. But creating a business plan is also part of your due diligence. Securing a loan and insurance, which is not as simple as just calling your bank, calling your insurance agent. We'll get into that in a minute. Raising capital from investors to do the deal. Now, actually implementing the business plan. This gets into hiring contractors, hiring paving people to come pave a parking lot, roofers to come fix roofs, plumbers to come fix plumbing, so on and so forth. But also you have to realize you're managing an operating business. That's number 6. Managing current tenants, leasing. You got to make sure cash flow is still coming in. And then number 7, on top of that, you're managing the finances of the property. You've got quarterly reporting to your investors and your lenders. You've got investor relations. You've got approving payables from your property manager. So there's a lot of back office stuff going on. Tax reporting, both you're filing tax returns for multiple entities. You're also sending multiple tax returns to your investors annually. So that's a very time intensive and requires a lot of expertise in knowing what you're doing with that. And then ultimately monitoring when to sell or refinance the property to ensure the highest gains for your investors. Because at the end of the day, we're fiduciaries, and we have to make decisions based on the good of our investors as a whole. And again, the headline at the bottom: you can't rely on your third-party vendor to make a deal successful. The GP sets the tone and drives the process. So it's not as simple as hiring a property manager and said, "Okay, go fix everything and make this a profitable deal for me." You have to be in the weeds, and you have to be involved in every element of executing the business plan.
Yeah, when we say we're talking really about general partners, because that's essentially the job of the general partner.
Yeah.
Now, if LPs sometimes invest as thinking that they can do their own deals, I'm sure they can in some scenarios, but there is a lot that they need to focus on. So if they if they have a day job, or if they have bandwidth issues, then it could be unrealistic to actually focus on all these things well.
Sure. All right, so we talked about experience matters, but relationships matter also. And for the business that each of you are in, your relationships weren't formed overnight. It takes time. So here are just a handful of the types of relationships it takes for a sponsor to be successful. First of all, you've got to have relationships with your commercial real estate brokers in the markets where you're looking to invest. And these relationships don't happen immediately. Brokers, like anything, make money when a deal closes. So they're incented to do business with folks they know can close deals. And unlike, multifamily is unique among commercial real estate classes in that there is a single broker at a transaction. There is not a broker on the buyer side and a broker on the seller side. There is a single broker. So your deal flow is going to be dependent on having good relationships with all of the brokers in that area, and them knowing that you have a reputation to close. Secondly, lenders for debt, and particularly agency debt. That's Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac, prefer borrowers that have track record with them, that have done deals with them before. So that doesn't happen overnight either. So having that track record with Fannie Mae and Freddie Mac goes a long way toward making sure that you've got a stable of lenders that you can call when you have a deal to look at.
Yeah, and then Fannie Mae and Freddie Mac are the largest lender in the multifamily space. No other asset class has Fannie Mae and Freddie Mac that essentially backstops the debt liquidity in the market.
Right.
Multifamily has that. Office doesn't have it. Hotels, industrial, none of those asset classes, no matter how stable or unstable they are, do not have access to that type of debt capital.
Insurance carriers, for most multifamily deals, you're not going to call your local State Farm agent and get an insurance policy for an apartment development. And the insurance market is very nuanced. Again, you don't call 4 real estate brokers and get the best bid because anyway, that's nuanced. You typically pick 1 or 2 and do business with them. But anyway, property managers, choose the right one for the job. Property managers, I say this all the time, they're like tools in a toolbox. You use a hammer for a job, you need a hammer. You use a saw for the job, you need a saw. The property managers often specialize in properties of various sizes, of various asset class. There are property managers that focus on large A properties. There are property managers that focus on very small B and C properties. So knowing your property manager's strengths and expertise means you choose the right one for the job. So that also means having relationships with a lot of different property managers. Building contractors, obviously, if you've ever tried to get a deck built or your roof done, hiring a quality contractor to show up on time to give you the best price to stand by their work, that's a huge deal, especially when you're doing a $1 million renovation. Attorneys and CPAs for legal and accounting advice. The right attorney and the right CPA can help you make or lose tens of thousands or hundreds of thousands of dollars. Tax consultant. That's having your property taxes reviewed and appealed every year to make sure that you are paying the lowest possible property tax possible. Cost segregation consultant that gets into accelerated depreciation and making sure that you have the most favorable tax treatment for you and your LPs. Data service provider, are you getting the most updated CoStar, Reis, and other information that helps make you good decisions, helps you make good decisions on the market you're in and the properties that you're competing against. And then a title company, engineer, property survey. I can't tell you, the number of times we've looked at a closing statement from a title company and we found errors of thousands of dollars because, closing statements can be 4 or 5 pages long of just numbers. Looks like a spreadsheet. And if you don't know what you're looking for and you don't know what things should cost, it's easy to miss it. So having good relationships with title companies and engineers are key. Okay, and then reputation and specialization matters. So we focus on workforce and multifamily housing in the Southeast. That's all we do. It's one by developing that expertise and that specialization in that area. We can quickly look at a deal and know what works, what doesn't work, what's broken, what needs to be fixed, and how we're going to fix it. So, there are sponsors out there that do have multiple disciplines within their shop, and they may be staffed for that. They may do self-storage, they may do net leased properties, so on and so forth. But those are typically more on the institutional operator side. Multifamily syndicators, in our opinion, should specialize just on multifamily because that's where you're going to develop your expertise and become really good at what you do.
Yeah, because I think that some sponsors, go where the wind is blowing only because, they think that there's more upside in a certain, part of the real estate market. But we kind of think differently. We think that, you can make money in any part of the cycle. If you are in your asset class in such a way that you are knocking every door down to make sure that you get the best possible deal flow, then you're going to find the best deals that way versus spreading yourself too thin and going into other asset classes that you may or may not know too well as much as multifamily, and then make certain mistakes that will be costly for them and their investors.
Sure. All right, and then finally, the final sponsor issue, which is important for you to know as a potential investor, is understand how the sponsor evaluates opportunity. What criteria does the sponsor use to determine what and where they're going to invest in? Mohi mentioned a few minutes ago that we focus on primary and secondary markets in the Southeast. We focus on deals that have a certain population size, a diversified economy. We don't want to be in the one factory town. That if the factory goes out of business, then suddenly nobody has any money. We want to be diversified economies with stable and growing populations. We want to have average or growing average median incomes. We want to have a good stock of oversupply of multifamily properties. So anyway, there are a number of happy to talk to you guys individually if you have interest to hear about how we evaluate opportunities. But it's important for you as an investor to understand how does your sponsor evaluate opportunities? Are they jumping to whatever the shiny new thing is? Are they looking at an A plus property today? Are they looking at a self-storage deal tomorrow? Or are they looking at a Class C value add the next day? So
or a hotel or an office.
or a hotel or an office.
Now let's talk about the deal issues.
Yeah, so we've already covered you issues, we've covered sponsor issues, and I think this is this is really where the third piece that a lot of potential investors spend an awful lot of time on, and that's, first of all, are there any time bombs in the business plan that could really derail the plan or result in a capital call, which is your sponsor calling you and asking you to put more money into a deal. First of all, loan maturity. So how does the sponsor's pro forma, what type of debt are they putting on it? Is it an agency loan? Is it a bridge loan, which is a shorter term loan that you typically use for value add and capital improvements? So does the loan term match the business plan? You know, if you've got a 3 or 4 year business plan and you've got a 2-year loan, well, you've got a problem that you need to at least make sure that the sponsor has made plans for why they've made that assumption.
Yeah, I think it's okay to have a refinancing assumption in your plan. It just needs to be in such a way that you're not your sponsor is not being too aggressive in what assumptions they're making on the refinancing. You know, if you want to refinance your bridge debt with permanent financing during the whole period, it just needs to be a realistic assumption. And so we can get into the weeds of it, but at this point, we're trying to keep everything at a more high level. But that's one of the things that you need to look at.
Sure. So when it comes to the business plan, if your sponsor is looking to renovate a certain number of units, maybe repave the road, put new roofs on, are those expenses fully capitalized or accounted for? Meaning, have they raised enough equity from investors, or is there enough money in the loan to make sure those improvements can be done in a timely manner?
Yeah, it should be sitting aside.
It should be sitting aside. And in the same breath, are there enough reserves set aside that the lender is required? And another deal issue: tax and insurance assumptions. So whenever a multifamily property trades or sells, there's typically a tax reassessment. And taxes will typically go up. So, you know, at this point, insurance assumptions. The insurance market has gotten to be nuts. And frankly, we should probably do another webinar in the near future on insurance. We're seeing insurance rates on properties that have no claims, no problems, no historical issues, go up by 40 and 50%. We're seeing deals now that we're evaluating in the market to purchase where insurance is going up by a factor of 3x or 4x over what the current owner has. So, you know, the question, the point for you as a investor is look at the insurance and tax assumptions that your sponsor is making, and
make sure they're realistic.
Make sure they're realistic considering where we are in the marketplace. All right, so when you're evaluating a deal, it comes down to the local market. You know, there's that old saying that all politics is local, but all real estate is local also. So it's hard to look at macro sort of national statistics and extrapolate how they apply to a local market. So you've heard about location. Any relative to product marketing, there's the 5 Ps: product, place, price, people, and promotion. And I think those are 5 things that it's worthwhile thinking through as you're an investor also. So the product. What type of product are you investing in? Like, is it a lot of 1 bedrooms relative to the market, or is it a bunch of 2 bedrooms and 3 bedrooms? You know, if you're in a property that has 50% 1 bedroom units, but it's a family area, well, that may be harder to lease than you would if you had more 3 and 4 bedrooms. Place, the town that you're in, is the population growing? Are there jobs? How's the economy doing? Are there other supporting services? To the granular level, are you down the street from a shopping mall? Are you down the street from a grocery store and other supporting services? Are you close to work? Are you close to arterial roads? And then it gets to price. So how do your rents stack up against your competitors? Are you the highest priced in the market? Are you the lowest priced in the market? If you're looking at improving, if your sponsor is looking at improving the property, are those rents sustainable versus what else is in the market? People, you're going to look at this in a couple different ways. First of all, who are your tenants? Where are they working? What are they doing? What kind of jobs do they have? How are incomes? But also people who's operating your property, the management company that your sponsor is going to bring in. Are they capable of managing a property of this size, of this vintage in this area? Do they have an expertise in this part of town? Do they have an expertise with leasing this type of thing? And then finally, promotion. How are you going to promote this product in the market? Are you going to have an online presence with on the various apartment leasing websites? Are you going to have a new website? Are you going to have banners out front? You have a lot of traffic on the road out front that you can have balloons and all that type of thing. So, understanding how your sponsor is going to promote this property to achieve their targeted rents. So, so that's a quick summary of the 5 Ps. So ultimately, property issues. What's the condition of the property? If it's a rough property, that maybe the business plan is to make it not so rough. That we're going to fix the siding and the roofs, and we're going to clean it up, and we're going to attract people that way. How's the occupancy? Is there high occupancy already? And there's really 2 types of occupancies as a investor you need to focus on. Physical occupancy is typically the number you're gonna hear.
Most people talk about that.
Physical occupancy is the number of units that are leased and the number of people who live there. Economic occupancy is the percentage of those folks that actually pay rent. So you can have a high occupancy, 90+%, but if you've got a lot of collections issues, people not paying rent, you could have 75, 70, or even lower economic occupancy. And that's really what gets down to the next point, which is cash flow and collections.
Yeah, you just need to make sure that going in that your GP or you have accounted for the economic occupancy. And it's okay to have low economic occupancy because it's probably reflected in the pricing as well. But you can't just say that, oh, it's 90% occupancy, so I'm going to get 90% of the rents.
I mean, we've had deals in the past where part of our business plan is we knew we were going to turn over 100% of the rent roll. If we had people that stayed at the new rents, great, but we assumed over a period of time that 100% of the existing tenants were going to turn over. Again, low occupancy or low economic occupancy is not bad. Just make sure your sponsor is accounted for that. And ultimately, is your property management company, like we referenced before, are they capable of managing a property of that type? Let's move on. Now, ultimately, it comes down to this. There's a lot of it is art, less than science. You can look at the statistics. You can look at whatever the spreadsheets say. You can make it. Frankly, you can make an underwriting performance say whatever you want it to. But does the deal make sense to you? A lot of real estate is intuitive, and trusting your instincts. There's an element to that in a good real estate deal. If your sponsor says, hey, we've got this Class B deal, and we're going to increase rents X number of dollars, and we're going to perform a 30% annual return. Well, I'm not saying that can't happen, but does it make sense to you? Are they raising rents enough? Are they adding enough value? Is that type of product going to lease in its market based on that? Do you trust the story? Okay. So, and here's where some of that intuition comes down. It is incumbent on you as an investor to dig into the details, to understand what you're getting into, because you're investing a lot of money in these deals. That said, there's also a balance of you getting into the weeds and the nitty-gritty on those micro issues, but also trusting your sponsor enough that they've done that due diligence and that research, and that they are capable of managing whatever comes their way. At the end of the day, remember, you're looking for a passive investment. You're looking for something where you can, write a check, trust the investment vehicle you're in, and get quarterly reporting and trust that your investment is in good hands.
Yeah, and you don't need to all the issues that we mentioned, these are not issues that you need to solve for. It just means that you need to make sure that your sponsor has solved for them and that you feel comfortable with those answers.
Absolutely. So again, like we mentioned earlier, there's no magic formula to it. It's a lot of work. So sorry if you were looking for the magic bullet. We don't have one. That old adage we all learned when we were kids, if the deal seems too good to be true, it probably is. And, I think this is the main takeaway for today. Find sponsors you can trust. The way we look at it, we would much rather do good deals with people we know and trust and good operators than try to do deals that look great with groups we don't fully know and don't fully trust. So anyway, that's we're 45 minutes into it, so we've got some time left for questions. I know we're at lunch hour now, so let's go ahead and if you have questions, go ahead and just in the chat, and we will.
So the first question is from Lindsay. It is there a reason for reevaluating investments strategy due to heavy value add opportunities with shorter turnaround period, less plentiful at a time of a market cycle, or is it something you say anyways? Sorry, I'm not sure if I follow that question. I'll go to the next one. What do you think about interest only loans right now?
So I think both of us have an opinion on, you'll also hear interest only loans called IO. So IO loans today are probably not a bad deal. If your deal pencils out and you can afford it. IO loans right now are typically shorter duration. They're going to be 2 to 3 years. Bridge loans with some renewal options. Those are pricing all in plus or minus 10%.
Well, for smaller deals,
for let's say 9 to 11, let's say on the bridge side. So if your business plan has some value add to it, and you think you can get your value add done in, let's say, a year, 18 months, 24 months at the max. Again, it's a tool that might make sense for you. Again, as long as you feel like you can refinance into lower cost debt at the end of your business plan.
Yeah, look, I mean, value add deals, will always benefit from interest only debt because, obviously your cash flows are depressed in the first couple of years. So you want your outflow to be as low as possible. And if you have principal that you're paying back with your loan, that eats into your cash flow a lot. So if it's a value add deal, I would say that yes, having an interest only loan is a good idea. But if it's like a stabilized deal that is clipping a coupon, you actually don't need interest only loans because what they do is that they increase the cost of your debt. But in some cases, when you have limited cash flow to begin with, then some of that interest only loans are very, very important.
Now, just to put a period on this subject, interest only loans, you'll hear a lot of there's a lot of pain in the market due to interest only loans. But these were loans that were originated back in 2020, 2021, when rates were very, very low. And now that those interest only loans have they adjust monthly. They're on their 30-day LIBOR back then and 30-day SOFR right now. So if your property didn't have cash flow to cover that, there's people are having a hard time refinancing out of those.
Okay, so we have time for one more. Any comment on cap rate projections and how that impacts evaluating deals?
Yeah, so cap rates, we have a lot of debate on this issue. Again, if you look at the definition of a cap rate is kind of what an investor's expectation of return would be on a 100% cash investment, completely unlevered, right? So would you accept, whatever rate, which so 6.5 cap would say it's a 6.5 cap unlevered return on an investment. It's basically a way of evaluating, sort of have an apples to apples comparison of various investments. So the idea of going in cap rate, we focus on a lot of value add deals. So cap rates are typically going to be much lower than market rate because there's problems with the deal.
Yeah.
There's either, it's not fully occupied, there's some collections issues.
Yeah, and then that's just the going in cap rate. But if the question was around also how you view cap rates going forward, we obviously look at what we're buying it for today, but then how can we improve the property and to improve the cap rate? So we'll buy something, well, let's just say a 5, and then improve the performance of that deal to like a 7, 7.5. Now, when we are looking at, when we exit the deal, like what sort of a value we would be prescribing to the investment. For us, it would be, we look at, we're tracking the cap rates as to what people are paying today, and what we were assuming a year ago, which was, let's just take an example, we would underwrite something for a 5 cap on exit. In today's market, as rates have gone up and we've tracked the market as to how the market is performing, we have increased those cap rates up to like 6%. Now, that number was fully baking in not knowing how high the Fed would go. Now that we know that the Fed is kind of slowing down its rate growth or close to the top, if not at the top, then we feel comfortable that this is kind of as high of a exit cap rate that we should be assuming. So assuming that we would be selling something in 2 to 3 years time, if this is kind of the top of the market from an interest rate standpoint and its effect on cap rates, then maybe, we would now be underwriting that same deal at a 5.75 on exit or something to that effect. So that's probably a long way of saying that cap rates are important, and that you have to be, we can use a cap rate of 5% on our deals on exit, and it would look like it's great, but we have to sell that asset in 3 to 5 years at that cap rate with that NOI. So there are a lot of things that have to go right for us to hit that number, and we just conservatively underwrite. So we make sure that we account for a lot of those risk factors in our underwriting.
Yeah, and typically we're always going to underwrite to a stabilized number well above that what we perform our exit to be. Hoping that we're able to sell for a lower cap rate.
Okay, so we have a couple more questions, but unfortunately we've run out of time. But we would love to answer those questions directly. Please reach out, or we will reach out to those individuals and get those questions answered if you would like. And at this point, as I had mentioned, we have. As we promised, we'll be sharing with you the Southeast U.S. multifamily market report. We will be sending you that link, and as soon as this webinar is over, you should be getting that email from us. And then also, if you are interested in investing alongside with us, we will soon be launching our next investment, and we will be providing you details on that shortly. But till then, and the next webinar, thank you for joining, and bye for now.
Thank you.